Anyone that was a tourist in the sector is now gone. Like, you can't sit through this sort of brutal price action and hang in there. If you haven't spent time on the sector and kind of really built conviction in the macro, you're long gone. This is just absolutely too painful. You saw it with the initial washout with how badly it reacted to sort of the AI DeepSeek and the subsequent washouts, and some of the only remaining stocks that had kind of held up, just like enCore. Like, I haven't owned it, but just seeing that just get absolutely annihilated. Like, it's super painful. Like I I haven't seen sentiment this bad in the sector, like maybe COVID lows, I guess.
Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Most of you know me as Triangle Investor from social media. Fergus Cullen, aka Trader Ferg, is back to my show. Ferg, as always, great to have you here. Welcome back.
Thank you for having me, Lucian. It's a pleasure to be here. And as I was saying earlier, I've got a category three cyclone on the way here. So if you lose me, apologies.
Sure. I hope everything will go okay. Let's cover a lot of things. Since we last time talked, it was a few months ago. In today's show, actually, I would like to cover some five, six commodities, your views on them, and if you're planning to own them or if you have them, and some specifics. I want to start actually with uranium, your views on the sector and the sentiment. Is uranium back to hated commodity levels? That's my first and main question.
Yeah. In short, I think anyone that was a tourist in the sector is now gone. Like, you can't sit through this sort of brutal price action and hang in there. If you haven't spent time on the sector and kind of really built conviction in the macro, you're long gone. This is just absolutely too painful. You saw it with the initial washout with how badly it reacted to sort of the AI DeepSeek and the subsequent washouts, and some of the only remaining stocks that had kind of held up, just like enCore. Like, I haven't owned it, but just seeing that just get absolutely annihilated. Like, it's super painful. Like I I haven't seen sentiment this bad in the sector, like maybe COVID lows, I guess. And so I find it fascinating as well, especially with the news flow, especially when you go through just all the layers, because it's a story that's very hard to play well with because you've got to deal with the miners. But once you get past that, it's still an airtight thesis. You've got demand that is going to show up. You don't need the AI thesis to make it work. You've got sort of, what is it, 440 operating reactors, got another 65 under construction. That's that cannot be supplied by the current operational like mines, and even with brownfields, even like playing sort of greenfields. If you go out to 2030, it's not enough. It's falling short. We need more pounds to come on. And then when you look at what's happening, like, there's just no recognition of that. Like last year with replacement contracts, utilities, it should have been in the 185 just for replacement, knowing that in the past they've overcontracted up to sort of 130, 140%. Last year they contracted 105 million pounds, so just over half. And it's one of those frustrating sectors where it's so opaque, you can't really cling to anything, because everyone clings to spot, and that's just been trading down and down. And even if you look at Cameco's got a great page on its website where you can look at term and spot, and spot's generally traded above term whenever the market gets tight. And this is sort of one of the only times, unless you go back to kind of Fukushima, or just after the market really collapsed in 2008, where spots really dropped off or terms held up. And with spot down in the 65, it's a weird market. There's no futures to kind of keep a handful of traders honest, and it's just trading down and down on very low liquidity, very low volumes. And to top it off, yeah, you've got the price action and all the equities just and the short interest is just crazy across them all as well. You've got between 10 and 20% on most of the liquid names and short interest. So it is brutal, which is fascinating when you kind of you know this demand is coming down the pipeline. You know that it's only about 40% contracted if you go right out to 2035, 2040. It's 40% contracted. That other it's got to source that other 60%, and at the same time you've got a large amount of the primary supply rolling over. Like you only have to pull up Kazatoprom's investor presentation, and they go from 33,000 tons of uranium, and they peak out at in 27, 28, and then that's down to 15 by 2035, and by 2045 it's down to 5.
Yeah,
So
something like that.
yeah, it literally disappears, and this is the same time if you're just watching the Chinese build out. It's fascinating, but it's brutal. It's nothing like just it hurts to even open and look at the stock prices, because every day, if you know you buy, you're going to open up and you're going to see something else down another 5%. Yeah, I don't blame anyone at all for sticking with the ETFs at this point, because it's such a minefield across all the equities. They just seem to constantly disappoint.
Yeah, you described the sector very well, Ferg, but what are you currently doing? Are you buying uranium stocks? Do you hold them or you sold them? What is your current uranium position with regards to the equities?
So I sold down quite heavily in November last year. And that was after getting quite early into some of the producers, and I just didn't have the confidence to keep holding them with just through the reporting. Like there's so many problems with the ramp up, so I really scaled back the position. But yeah, I do still have quite a few very talky names. I kind of the other side of all these high short interest positions is some of them are gonna, if the spot price starts to move, or the utilities come aside to start contracting, like some of these they're 15-20% short. That's like 2-3 weeks of trading for the shorts to get out. So you could see some you could see some real short squeezes. So yeah, I still have maybe it's sub maybe 20% of my portfolio now in uranium, and it's some of it's in spot, but most of it's in some of the sort of mainly sort of African miners still, that I just see a lot of talk once this thesis gains traction. Like one I'm happy to talk about, it's like Bannerman. I love how you just have the different tiers. You have like a Tango 8, and then you have the main Tango, and each one can just as the spot price goes and the term price goes where I think it needs to go, each of these is just going to become viable, and it's just going to be like a sort of step up action. And but yeah, it's been horrifically painful holding these, and I don't blame anyone for sort of running from the sector, because it's mentally taxing seeing this sort of price action.
Yeah, I want to ask you about two more specific names, and you mentioned enCore at the beginning of this talk. Do you believe that this price action after the Q results have been reported, do you believe that the stock is now oversold, that was overreacted by the market, and it was like down 40% at that day? Okay, it turned back green the other day with 15% or something like that. Do you believe that it is a good buy right now? I mean, enCore Energy.
I don't understand the company well enough to say if it's a good buy or not. I did honestly think there was an opportunity when I saw it down that much,
Yeah.
because I think what happened there was there's a large newsletter writer, and I think a lot of people probably use market orders, and there just isn't enough liquidity for if everyone dumps it on that. As for is it a good buy? Well, I'd like to know why the CEO exited. They just kind of had that in the footnotes. So it would be nice to just sort of have a bit more clarity because he's very well respected in the sector, and
Yes.
to see him head for the exit when they then missed earnings, yeah, it doesn't really add any confidence. So no, I haven't added. I just see more opportunity in other places. I've got my bets in this sector. I've held a lot of these for years now. I bought a lot of the positions I still hold today, and back in 2020, and yeah, I just see better risk rewards,
Mhm.
or not, maybe not even risk. Yeah, I guess risk rewards, because they're just it's just such a minefield in the sector with where you're going to go. Like, do you want to go with I don't know, like next gen? I just don't like how they manage that. I just don't like management at all. I really have issues um, with them. Africa, you've got all the issues. Like I'm still a very it's been a very painful like bag holding experience to the likes of Global Atomic.
Yeah, that's my
And
next question.
yeah,
I want to hear
yeah,
your take on the global atomic. Feel free to expand a bit.
yeah. So that's been I've I rode that up and I rode it down, thinking that they would get the a finance or a JV, and here we are, where essentially the bank finances off with a freeze from the Trump administration, and it essentially has to be JV. Otherwise, you're going to have this painful
Agreed.
every like I think they've got enough cash to get them through to about April at the moment, and then you're going to be you're going to have to dilute at a record low share price, which is just so value destructive. So it's really all pinned around the JV at this point, and it's so binary. Like, everyone's just waiting for this announcement. Like, if I often get asked, like, is it just a great setup here? And I think with Global Atomic, you almost need to just to wait for the news and suck it up, even if you miss like a sort of a big jump in the stock price. Because otherwise, if this like sort of always promising the JV lasts and they have to keep subsequent dilutions, you're just going to get obliterated. So yeah, it's just a nasty situation with such a great asset, and it's
Yes.
almost a case study for what can go wrong in Africa, even with competent management. Like, I don't know that Roma could have done anything differently.
Actually, not.
Obviously got a lot of skin in the game,
Yeah.
and it's just a lesson. And maybe with hindsight, once something like this gets announced, you should really dial the position right back to maybe always dial it right back to something that you're comfortable to manage the volatility, maybe back to 1%. And then when you get a surety again, then you can size it up again. But probably been a rule I've been thinking about with some of these situations,
Yeah.
rather than just kind of have sort of sunk costs fallacy, when you just get you just keep hanging on, hoping that the news is around the corner, and it just slides down slides down the hill with the price action.
Yeah, all good points. Let's move to gold. I believe that you are not a big fan of gold, and from a perspective of a contrarian, speculator, trader, gold is actually not that attractive, right?
I wouldn't say that. I'd say um, I have tried to play gold, but it was with sort of an indirect play with a PGM miner, which wasn't the best way in the end, because they kind of sold some of it off in royalties and put a collar on the rest. So that didn't really work. My trouble with gold is I don't want to own any more miners, and this just goes back to what we've just talked about with Global Atomic. I'm trying my best to not fool my portfolio of miners, because I know they just come with a lot of heartache. What is interesting with gold is just you have the commodity absolutely ripping, and you have the gold miners just not even moving. Like, you have GDX at like a sort of a hasn't budged. Well, gold's rocketed, and then you have GDXJ sort of at a record discount to GDX, and so you've got the juniors as cheap as they're ever going to be. So I do constantly look at that as just a trade like GDXJ. I'm just seeing so much opportunity. It just feels lazy buying just an ETF and holding it when I see so many like niche stuff that I think the risk reward's great. But yeah, I think GDXJ works fantastically from here, and I'm really considering it. Just have yet to pull the trigger because I have to sell something as well. Pretty fully invested now, but I think that really works. It reminds me back in 2021 when you saw coal prices take off and the miners hadn't yet moved. Granted, they're a lot more talk to the price than gold juniors, or I guess you could argue that. But yeah, it's fascinating how little price performance has come out of the junior gold miners when gold's done what it has, and I think that gap does close, particularly if you get right down the sort of the macro. Like I follow Luke Roman's work, and he sees gold being needing to be revalued essentially as a lever moving forward, and so that would make them even more attractive. And so, yeah, I'm definitely considering the trade, but it's something that I don't have it. I have very little exposure to currently.
Okay, would you say the same for silver? I mean, silver is on the other hand far from all-time highs like gold, and is actually lagging behind gold a lot. A lot of experts say that after gold rallies, silver follow a bit later, but we haven't seen that scenario actually. So, would you say that silver miners would be a much better buy than the gold miners, like you said?
Potentially, like silver's always acted like sort of a leveraged form of gold. Again, I don't have exposure to it. I do look at exactly the same with this silver miners ETF. I think that'll do great. It's just going around the whole commodity space and where is the most leverage at this point. Also looking at some quality gold names and looking at like sort of bull call spreads on them. Same with silver miners. I'm considering all of it. It's um, it's just a funny time now because I feel like there's there's no there's no speculative, there's no retail interest in all of this, which is also why the miners aren't moving and the gold price is moving. The gold price is moving for sort of more sort of macro reasons, buying by a lot of developing countries, buying by central banks, and whereas the miners have always been more of a more sort of a retail expression of the trade. And yeah, when I still look at gold and silver, I still come back to PGMs. I just love that trade far more because it's similar to uranium. You've just got so few players, and they're so crappy to play it, and it's such a tight niche market that I feel like when you can understand that, there's um, a lot of upside there. Granted, I should probably just have some exposure to all of them and not try and be too smart.
Mhm. If I remember correctly, you were also bullish on offshore when we
Yeah,
spoke last time. Are you still bullish on offshore stocks, and what's your take on the sector going forward?
yeah. So that's one of the what I think is one of the best risk rewards. It's got dirt cheap, and recently it's got even cheaper. There's nothing like buying a whole lot of something and then seeing it go down another 10% a few weeks later. It's with offshore. I think it has the largest moat. I wrote a piece a while ago that was just like outlining my whole thesis of moats and cannibals, and it's just this idea that we're going into an inflationary world, and you're gonna want the assets that have the highest sort of energy input. They're the hardest to replace moving forward, and they'll be in high demand. And I think the offshore, particularly drill ships, they tick all those boxes. And it's just these companies have gone through bankruptcy, written off all their debt. Some of them even gone through two bankruptcies. I've got two positions that have been through two bankruptcies, and they're just going to be so hard to compete with moving forward. And it's a very different trade also to when they relisted as well, because now you're buying them knowing their backlog. So anyone can look up for Tidewater, for example, their CEO Quinton Keen. He just reported in their latest earnings. I think they're revenues, I believe it's 81% covered by their backlog, and that's getting just getting dirt cheap. That you know that money's coming in, and they the same with Valaris. I think that's even higher. I think that's 85% covered by backlog, and so they're just people have got very, very bearish on them because of the recent oil sentiment, like especially now. But if you can look past it and just look out to sort of 26, these things are going to start printing money, and they can continue printing money for 5 years plus because there's no additional supply. And if come back to now as well, you've got certain drill ships being scrapped, and so that's sort of narrowing the supply even more. And I often get asked why I prefer sort of the rigs over just say Canadian oil producers. And I think the ability to produce to expand that fleet is going to be so constrained. Whereas with oil producers, you'll have more pop up globally. I know if you're an expert in the area and you can pick the real quality ones, then yeah, you'll probably outperform maybe even the rigs. But I think for someone that's a more generalist like myself, I'm not smart enough to pick the best oil producer. With all these bankruptcies and also the consolidation, like I have this chart that I did in a recent oil piece where if you have the likes of, if you go far enough along and think, as I do, that there'll be further consolidation, you could have a rig company that has up to 14, 15 billion of write-offs through all these bankruptcies and all these consolidations, and someone has to compete with that. And these, for anyone that's not aware, like a drill ship, currently you can't order them because there's no space in the shipyards, and the last ones delivered were a bit over $1 billion. So now if you're going to try and order one, you're going to have to wait 5 years. Instead of putting down 10%, you'll have to put down 40%. And you've got to compete with these current drill contractors that are going to have their entire fleet with zero debt against it.
Yeah.
And yeah, like good luck with that. And that's why I think these are just going to have fantastic earnings. Granted, at the moment, they're taking a hammering, and they're also got 10 to 15% short interest across the board. So they're just taking an absolute hammering with everyone looking at the next quarter, not looking out a year or two.
Yeah, so you do you believe that Valaris is a good it's a good entry point at these levels?
Fantastic. But I believe that 10% ago as well. So just as a warning,
Okay,
I,
okay.
I, I was buying it with both hands. Yeah, 10% higher. And it's been painful to watch it just continue to get smashed. Yeah.
Okay, Ferg, copper. Copper performance is very solid recently. What do you think of that?
Yeah, I look at copper and I can't get excited just because it's too consensus to me. I've got people I really respect that all over it, but I could never find a particularly asymmetric way to play it. The fact that all the majors were chasing it and willing to spin out all their other assets to chase copper was kind of was not what I wanted to see. I'd prefer to be like Anglo, wanting to focus on transition metals, means they're pouring money into this, and all things equal, more supply will come on in the future than the thing they're dumping. Say they dumped all their thermal coal exposure, they're due to spin out their PGM exposure by Q2 this year. And those are where there's going to be underinvestment in capex, and I believe demand's going to hold up in those areas. So I think all things equal, they'll outperform copper, and especially if you also look through just the future investments that all the mining majors are making, they're all pouring money into copper exploration and development. And so yeah, it's not an area. And lastly, if you go back, and I don't know how much the demand forecast has been revised, but I know S&P Global, they saw by 2035 about half of all copper demand would be renewable based, and I just don't see that happening. I think there's I just see a lot of that evaporating, and that's gonna all things equal, that'll mean there won't be the same sort of price reaction with some of this other stuff where there's been no demand forecast and then demand turns out to be quite strong. It's kind of
Yeah,
like I put copper in the middle. I think anyone long copper will still do well. I don't think it's as bad as the likes of lithium, where I just don't see a lot of that demand showing up at all because of different battery chemistries and just too much supply coming on. There was too much invested on a future that's not where lithium ion isn't going to be the ultimate winner in battery chemistry.
agreed. We didn't touch a lot on met coal and thermal. How are your views for both of them? And the main question, if you allocate capital today, would you be more weighted towards met coal or thermal?
I still like them both a lot. I think thermal's more hated at the moment, and I've been surprised by how much I didn't see some of the more developing countries like Indonesia sort of chasing the whole green agenda and really saying they were going to dial back coal investment and make it hard for the coal miners. So yeah, I think you at this point you definitely want to be with some of the lower cost thermal coal producers and go with the higher quality coal like high quality Newcastle. And I think you do really well over the longer term. Shorter term, there's not many catalysts that are looking to turn things around. But yeah, I think if you can, like a lot of the stuff, you've got to have sort of a 2 3 year plus sort of view on the market, and then you can see there's just a big supply demand gap, and it keeps growing. Like anyone only needs to look at headlines, and everyone that thought coal was in terminal decline every year makes a new high, and this is against yeah all the ideas that we would be off it, and also coal kind of got a disservice by the spike on the back of the sort of Russian invasion. It was always a long-term thesis on developing market growth, mainly like industry and aircon. Like renewables were never going to play a big part in any chart. There's plenty of charts that will show how successful renewables have been in a lot of developing countries. I've got some good charts for it for both China and India. But the key thing is always to distinguish capacity from generation. And a lot will show you that the likes of China has now got over 50% renewable capacity. But when you change it to actual generation, you've got the likes of solar, which goes from 20% of overall capacity to something that's 3% of generation. And that's an absolute key thing to keep an eye on, because that's a trick a lot of headlines make to try and sort of bolster the idea that there is a transition when really coal is playing the dominant role and will continue to play the dominant role for a decade still. And interestingly, it also balances a lot of the renewable production in the likes of China and India, because a lot of people don't realize hydro is very cyclical, produces a lot more in the wet seasons and really drops off. So coal has to pick up and dry, and same with wind and same with solar. Solar obviously produces a lot less in the winter than in the summer, and coal has to counteract that. And so it's almost a battery in the system, if you will.
Yeah, yeah. I got a question from one of my followers. He says that you like rhodium, but he asked the
Hmm.
question, why not platinum too for hydrogen vehicles? What's your
Yeah,
comment?
so rhodium is a pure byproduct mostly of platinum production. That you do get it from palladium rich deposits as well. But when you look at the vast majority of global rhodium production, like 85% comes from just one reef around the Bushveld in South Africa. And some of those deposits are up to 8 9% rhodium. Whereas if you look at Zimbabwe, Nornickel's, Russian deposits, they're all 2 to 3% rhodium. And so the rhodium is very centered in one small area where it's going into it almost looks like the Kazatomprom chart. I've joked about it before, that it just rolls over from 2030, and there's no there's no plans to bring any significant mine supply on. And so the question of why rhodium over platinum, rhodium is essentially a call option. It's like an out of the money call option on where platinum goes, because with it's far more illiquid. It's a tiny little market. It's actually got some similarities to uranium, interestingly. I believe 75 to 80% is signed through long-term contracts. And what you see is with where it's trading in a tight range at the moment, around 4,700 an ounce. That's kind of seems to be where the cost of production is for a lot of the miners. And if it goes below that, they're not willing to sell. So it just sits at that level. And it's almost like almost call it like a patient's died. You saw like the heartbeat go down, and then it's just gone flat, and it trades up and down like 1 or 2%. And if you look at the history of it, it's massively cyclical, because being a byproduct, you can't directly increase supply of rhodium without it just being as a result of increasing over these palladium-rich deposits or the platinum deposits in South Africa. It comes as a byproduct of increasing mining PGMs. It's just a small part of them, even though it does play a big part of the company's earnings. And when you go down this rabbit hole, it gets really interesting, because a large percentage of the growth in global PGM markets was supposed to come from North Nickel. And that's due to sanctions and a whole lot of other reasons. They pushed back two of their largest projects, which was supposed to add about 8% to global PGM production, mainly palladium. Mm-hmm. But that was supposed to start in 2023 and be ramping by 2027. And that's now, they haven't even given a guideline for when they're going to start, but it's suggested that they might start in the next year. But granted, that was a 4-year ramp. They're even if they start next year, you're really out to 2030 before they can bring on that additional PGM production. And then that's the palladium heavy production with very little rhodium. So that doesn't solve the rhodium issue. And coming back to why I love this trade so much is the forecast is that who cares about any of this, because we're going fully EV. So we don't need all this all these PGMs for production once we get out past 2030, because EV adoption is going to ramp. Whereas I see a very different future, and I think you can study this very closely if you just look at BYD's annual monthly sales and production reports, and they're rapidly switching from EVs to plug-in hybrids. And this matters a lot, because when you have a plug-in hybrid engine, you are constantly switching back and forward between the ICE engine and the battery. And when the engine at the combustion phase, that's when you need the most catalytic converters to deal with the emissions. Mm-hmm. And so this is actually really boosting PGM demand. And I think the more people should really study what's going on in China with their EV industry, because it started out at like 4. So the state entities said, like, we want to dominate this industry. Here's a whole lot of capital, a whole lot of loans. And at one point they got up to, I believe it was even 400 EV companies. And as of today, it's down to 70. They've removed the vast majority of subsidies. And really it's only 8 dominant companies. And really it's only, if you dial it right down, BYD now has 37% domestic share in China. And if anyone's looked at their cars recently, they're just almost impossible to compete with for any Western producer anyway. You're getting the Seal, which I always point to, that's for $14,000 US, that does 2,100 kilometers on a single tank of gas and a charge.